My name's Ethan Braid. Today we're going to look at the 4% versus the 5% spending strategy in retirement using actual data over the last 23 years. Our first illustration is going to be for the Vanguard Balanced Fund, going back to the year 2000 and using what I call the rigid form of the 5% spending strategy. Rigid meaning that we take a 5% fixed distribution in the first year of a retirement, and then we grow that distribution by 3% for inflation every single year. What we see here in this example is that if we began the year 2000, and I'm picking the year 2000 intentionally because I want to demonstrate also what happens if you retire into a recession. What we see here is that if you started the year 2000 with a hypothetical $1 million portfolio, 22 years later, you ran out of money using the 5% strategy. Now, this is a good fund. There's nothing wrong with this Vanguard Balanced Index Fund. It's a 60-40 asset allocation. It's a fine fund. However, a 5% distribution off this fund is just too much for the portfolio to handle in the face of 2 recessions in a market that basically went sideways for over a decade. Here are the numbers for the 5% strategy. You can see that we start in 2000 with $1 million. Here's our $50,000 5% fixed distribution, and then we grow that distribution by 3% every single year of this retirement spending plan. And we can see that here we are in the year 2022, we've run out of money. To deepen our perspective on the 5% spending strategy, here's some research by Morningstar where they're demonstrating that for the 5% spending rate in a 25-year retirement, you don't have a probability of success greater than 79%. What we're seeing here in these different columns are asset allocation strategies ranging from 100% bonds to 100% stocks, and the associated probability of success. Success being that you didn't run out of money. You were able to maintain your spending for the duration of the 25 years. And we can clearly see that if you use 5%, per Morningstar's research, you've got about a 1 in 5 chance of not having enough money to last your retirement. Now let's take a look at the 4% spending rule, going back to the year 2000 using the same balanced index fund with one difference. I made the starting point March 24 of 2000, the high for the year for the S&P 500. And the good news here, what we see is that despite that there were 2 recessions and a sideways market for over a decade, the 4% spending rule prevails, and you still have money after 23 years. However, you've lost about half your money in that time. So this is something to consider when planning your retirement. If leaving an inheritance to your children or grandchildren is important, the 4% rule might be a little too much in terms of spending. Also, if longevity runs in your family, that may be an issue. If you were 60 years old when you retired in this example, you would now be 83, but have half the amount of money you started with. That can be very stressful for some people. So one thing to ask yourself is, are you comfortable watching your retirement nest egg deplete throughout your retirement? But the good news is that the 4% strategy is pretty safe if you have the proper asset allocation, something like a balanced fund like what we're looking at. Now let's take a look at the numbers. Here we are starting in March of 2000 with $1 million. Again, this time we're taking out 40,000, 4% rule, growing it by inflation, and where we end up is $531,000 as of the end of November this year, and our final distribution for income, $78,943. This last illustration is for the same balanced index fund, starting in the year 2000, but this time we're using 3.5%. And it's amazing what just 0.5% difference can make for your portfolio over a long period of time. If we see here, we start with $1 million and we finish with more than we started in our retirement. In this case, $1.1 million, despite the fact that we went through not one, but two recessions, and then the volatility in March of 2020 and last year, 2022, we're still ahead. So this is something, again, to think about when planning your retirement spending strategy. Is growing your wealth throughout your retirement and having more security important to you? Is leaving an inheritance to your children or grandchildren important to you? If the answer to either one of those is yes, then consider a distribution strategy of 3.5 or 3, somewhere in that range, and you'll have a lot less to worry about during your retirement. I hope this video was helpful. I hope this video gets you thinking and helps you better analyze your situation and improve your family's financial plan.